Hi everyone, my name is Edwin Lim. In this video, we will cover topic 3, adjusting and closing process. Just an overview for this topic. Today we will go through the second half stage of the accounting cycle. We will conduct balance day adjustments at the reporting date to make sure that expenses and revenues are recorded in the correct accounting period. So our periodic profit is more useful for decision making. Adjusting entries mean we try to assign the financial effects of transactions to the appropriate accounting period. When we conduct balance day adjustments, one revenue or one expense account will be affected, and another asset or liability account will be affected. There is, however, no effect on cash at bank account because when we do adjusting entries, they are internal adjustments, not external exchange. We then proceed to closing entries. We will only conduct closing entries for revenue and expense accounts because they are temporary accounts. We need to reset the balance of revenue and expense to zero. We close revenue and expense accounts to profit and loss summary account. In profit and loss summary account, we would then determine if we have a net profit or net loss. We then close profit and loss summary account to retain profit account. However, we do not close asset, liability, and equity accounts because they are permanent accounts. We, however, calculate the closing balance for asset, liability, and equity accounts so their balance can be carried forward to the next period. Once we have done balance day adjustments and closing entries, we will prepare an adjusted trial balance. Based on adjusted trial balance, we will prepare the financial statements, which are the outputs of the accounting cycle. Finally, we will also look at reversing entries. Note that reversing entries are done at the start of the new period, not at the reporting date. Reversing entries are optional. In other words, they are not compulsory. We can only reverse certain types of balance day adjustments, and we reverse certain types of internal adjustments just to simplify the recordings. Alright, make sure that you understand these learning objectives. Before we go through today's topic, let's look at your revision question 2 for highly limited, which you are supposed to attempt before viewing this video. On 1st of June, $1 million of share capital is issued. We receive money from shareholders, so debit cash at bank $1 million. And at the same time, shareholders have a residual claim of the company. When equity increases, we credit share capital $1 million. On 3rd, we purchase a motor vehicle with 10K cash and 15K bank loan. Here we know that the motor vehicle is 25K. So we debit motor vehicle 25K, credit cash 10K, and loan payable 15K. On 5th, we purchase $500,000 of inventory on credit. The credit term is 2/10 and /30, which means we must pay the account within 30 days. And if we pay it within 10 days, we are entitled to a 2% discount. When we purchase the goods on credit, we debit inventory, credit accounts payable $500,000. On 10th, we made cash sales of 800K. The cost of goods sold is 400K, so there are two sets of entries. First, to recognize the cash received from sales revenue at selling price. Here we debit cash 800K and credit sales revenue 800K. Then, we need to also account for cost of goods sold, which is a form of expense, so we debit cost of goods sold 400K. And we have to reduce our inventory by crediting inventory 400K at cost. On 13th, we paid the supplier Huawei Limited. We paid within 10 days, so we are entitled to the discount. To fully reduce the amount we owe, we debit accounts payable $500,000, but we do not pay the full amount because we are entitled to a 2% discount. So here there are two credit entries. We credit cash at bank 490k, which is 98% of $500,000, and we also credit discount revenue 100k, which is 2% of $500,000. Discount revenue is a form of income, therefore we credit discount revenue. Then, on the same day, we sold inventory on credit to a customer, Mega Limited 200k. And Mega Limited must pay us within 30 days, and we do not give Mega Limited any discount. We have two sets of entries. First, that is to recognize credit sale by debit accounts receivable 200k and credit sales revenue 200k at selling price. Then we recognize cost of goods sold with a debit entry 100k, and we reduce inventory by a credit entry 100k at cost. On 14th, we issued a credit note to Mega Limited. What happens here? Because Mega Limited returned us faulty goods, $10,000, but the cost for these faulty goods are $5,000. So here we have two sets of entries. First of all, we will debit sales returns and allowances, 10k. Sales returns and allowances is a contra sales revenue account or contra income account. Contra means opposite, because usually we credit sales revenue. When it comes to sales returns and allowances, we have to debit this account. Then we credit accounts receivable because we reduce the amount owed by customers, so 10k. Then we do the second set of entry. We receive the goods back, so we debit inventory $5,000 at cost, and we will also reduce the cost of goods sold with a credit entry $5,000. On 17th, we paid insurance $2,000. So we debit insurance expense $2,000 and credit cash $2,000. What happens next? On 18th, we receive full payment from the customer Mega Limited. So we debit cash, credit accounts receivable. And here the amount is 190k because the customer Mega Limited previously returned us $10,000 of goods. On 27, we declare dividends. Because we declare dividends before the reporting date and we haven't paid those dividends, we must recognize the liability. So we debit dividends or retained profits, and we credit dividends payable 100k. Finally, on 30th, we paid salaries. Gross salaries is 10k. This includes 3k of PAYG tax to be paid in July. What does this mean? In Australia, the company will withhold a portion of the employee's salary and pay it to the ATO. ATO is Australian Taxation Office. So employees will only receive after-tax salary. Employees can, however, lodge a tax return every year. So here we debit salaries expense or wages, $10,000, and this is done at the gross amount or the total amount. We then credit cash at bank $7,000. This is the amount that will be received by the employees. And we credit PAYG tax payable, $3,000, which will be paid to the ATO, the Australian Taxation Office, next month. Alright, let's go through today's topic. Recall that this is the 8 stages of the accounting cycle. Our focus for today is on the last 4 stages: adjusting entry, closing entry, post-closing trial balance, and preparation of financial statements. A 5-minute revision. What did we cover in topic 2? We start with source documents such as invoices, remittance advice, which help us to identify the existence of external transaction. Source documents give us the evidence to support and to verify the transactions, and they can be used to resolve any disputes. We then first record all the external exchange or the transactions on journals. Journals are the books of original entries. We apply the concept of debit and credit, which are based on the accounting equation. So there must be at least one debit and one credit. We then post the entries from journals to ledger accounts. Every ledger account summarizes a particular transaction. For example, a cash at bank account details all the cash inflows and outflows. A ledger account allows us to determine the closing balance and total figure of each item. There are two formats for ledger accounts, the T format and the running balance format. So far, we focus on the T format. And every account has a unique ID, which can be found in the chart of accounts. We list the sequence of the items in financial statements based on the chart of accounts. Once we have determined the closing balance or total figure of each account, we prepare an unadjusted trial balance, which only capture the external transactions. Trial balance does not guarantee that everything is correct, but it can help us to at least ensure that the total debit equals to total credit. Before we talk about adjusting entries, we should understand the differences between external and internal transactions. External transactions involve exchange of items that have economic value, and we require the exchange to be conducted with an external party, such as shareholders, suppliers, and customers. For external transactions, usually there are source documents to provide the evidence. For example, we will receive a supplier's invoice. Examples of external transactions include paying employees' wages, we make a credit sale to customers, we borrow money from bank, and when we purchase equipment. All these transactions involve an external party and will provide us with the source documents. Internal adjustments are, however, records to introduce new data or adjust existing data. For example, we recognize depreciation expense. That is a new data. The intention of internal adjustment is to enhance or to improve the usefulness of information for decision making, so we do not overstate or understate our profit, assets, and liabilities. It is also to reflect economic events that are not exchanges. For example, if we talk about depreciation of asset, there is no exchange. But it is so important that we recognize depreciation expense under matching principle to make profit figure more meaningful. And we do so to internally adjust the carrying amount or the book value of the asset, because we know that most assets have limited useful life and their value can decline over time. Examples of internal transactions include the use of office supplies. For example, toner cartridges for printing, light bulbs, stationery, and so on. The second example is what we have mentioned earlier in regards to depreciation of asset. The third example is adjusting for prepaid rent because we have consumed the asset for months. Next, services are used but we have not paid for those services. This can be accrued electricity or accrued utilities, for example. Another example, we may need to also recognize doubtful debt expense even though our customers have not defaulted. It is always good to give an idea of how much receivables can be collected. All these internal transactions require us to do adjusting entries. So what exactly are adjusting entries? Adjusting entries are the process of assigning the financial effects of transactions to the appropriate accounting periods. Meaning we try to make sure that revenues, expenses, assets, and liabilities are recorded in the appropriate accounting period, so we do not overestimate or do not underestimate our net profit and net equity. So why do we do adjusting entries? First, because some transactions affect a firm's profit and financial position for more than one accounting period, so we need to do adjusting entries. In topic 1, we mentioned about accounting period assumption. We assume that the company can operate in the long run. But for financial reporting purposes, we divide the entity life into equal time period. Say, for example, for every 12 months or for every 6 months, we need to prepare an annual report. or a half-yearly report. So we apply the matching principle to make sure that revenues and expenses are recorded in the appropriate accounting period. The ultimate goal is that we can more accurately evaluate the financial performance for a period of time and evaluate financial position at a point in time. Also, because we are using accrual accounting, we can use accrual accounting to correct the limitation of cash accounting. Cash accounting requires expenses and revenues to be cash-based. Therefore, items such as depreciation will never be recognized under cash accounting because there is no cash involved when you recognize depreciation expense. So accrual accounting corrects this weakness. It makes our profit, our financial statements more useful for decision making. So how do we do adjusting entry? The same thing. We will rely on the double entry system. So for every adjusting entry, there must be one debit and one credit. The sum of debit must equal to the sum of credit. But what is so special about adjusting entry? One entry will affect income statement by revenue or expense, and another entry must affect balance sheet by asset or liability. And cash account is never affected when we do adjusting entry because there is no external exchange at all. When we do adjusting entries, we first record them at journal, then we post them to ledger accounts to update their total figure or balance figures. This allows us to then prepare an adjusted trial balance. This slide shows that there are 4 common types of adjusting entries. Under accruals, we have accrued revenues and accrued expenses. If you talk about accruals, that means revenue or expense have already been incurred, but cash flows will only happen later. For example, accrued revenues, which are an asset, mean that we have earned the revenue, but we have not received the cash. On the other hand, accrued expenses, which are a form of liability, mean that we have incurred the expenses, but we have not paid for those expenses. What about deferrals? Under deferrals, we have unearned revenues and prepayments. Under deferrals, cash flow already occurred, but revenue and expenses will only happen in a later period. For example, if we talk about unearned revenue, which is a form of liability, it means we have received the cash, but we have not earned the revenue because we have not provided goods and services. Prepaid expenses are a form of asset. It means we have paid cash, but we have not consumed the services, so expense has not been incurred. We will discuss each of these adjusting entries in detail later. We also have other types of adjusting entries. For example, bad and doubtful debt expense, which will be covered in topic 6. And we also have asset write-down, asset impairment, that will be covered in topics 8 and 9. We have depreciation, that will be covered in topic 9. And amortization, which will be covered by other accounting units and also in topic 9 as well. And today, we will briefly look at bad and doubtful debt and depreciation. So let's look at what is accrued revenue. Accrued revenue means revenue receivable. It means we have earned the revenue, so we will recognize the income, but we have not received the cash. Because we are entitled to receive cash in the next few months, we will recognize a receivable, which is an asset. So examples of accrued revenue include commissions earned by sales representative, but the company has not paid them. So the sales representative will recognize accrued revenue. Next, construction companies may have completed some works, but the client has not paid them. So the construction company will have accrued revenue in this case. Next, your company have excess cash and make some investment. Your company has earned some interest, but your company has not received the money from financial institutions. In this case, your company will recognize accrued revenue. Next, contractors may have provided consulting services to clients, but they have not received the money from clients because we usually give clients some time to settle the account. So we need to recognize accrued revenue. If we do not recognize accrued revenue, we will have understated both revenue and assets. Let's look at a few examples. First, interest on investment of $30,000 received on 15th every month. So on June 15, we would debit cash at bank $30,000 and credit interest revenue $30K. Note that this 15 June entry is not an adjusting entry. It is only a normal entry. We already mentioned we only do adjusting entry at balance day or reporting date. An adjusting entry does not involve cash. So the first entry here is not an adjusting entry. The 30th June entry is, however, an adjusting entry. Because we have earned the interest between 16 June to 30th June, we will recognize half month of interest earned. So we will debit interest receivable, credit interest revenue, 15K. Next, tradesman completes $20,000 of electrical work and $5,000 of maintenance. Both are unpaid by the client. Tradesman on 30th June will perform two adjusting entries to recognize the two types of services provided. So debit accrued revenue, which is an asset, and credit revenue for electrical work, 20K. And the tradesman will also debit accrued revenue and credit revenue for maintenance work for $5,000. Now let's look at unearned revenue. Unearned revenue has many other names. It is also called revenue received in advance, advances from customers, customer deposits, and they can also be called prepaid income or prepaid revenue. It can also be called deferred revenue. So prepaid revenue, deferred revenue, unearned revenue, revenue received in advance, all these refer to the same thing. It means we have received the cash from customer, but we have not earned it because we have not provided goods and services to customers. And recall your revision case study 1 in regards to Academies Australasia for the tuition fee. That is a case for unearned revenue. So please revisit the case for your revision. Other examples include magazine subscriptions fee received by publisher because the customer may have paid for 3 months, 6 months, or 1 year in advance. Another example, flight ticket bookings received by airline companies, gym membership received by fitness center, and insurance premiums received by insurance companies. Let's look at some examples for unearned revenue. First, on 1st of May, the insurance company received $1,200 annual insurance premium from a client. So debit cash, credit unearned insurance revenue, which is a liability. Note that the entry here on 1st of May is not an adjusting entry. It is only a normal entry. Then by June 30, we will have to perform the adjusting entry. Because the insurance company has earned 2 months of premium, so it will reduce the liability with a debit entry for unearned insurance revenue, $200, and this is calculated as 1,002 multiplied by 2 months divided by 12 months because the client paid annual premium. Then the insurance company will credit insurance revenue of $200. Okay. Another example, when you receive $1,800 rent for 3 months on 1st of June, on 1st of June, we will debit cash at bank, credit unearned rent revenue $1,800. Then on 30th June, we will perform the adjusting entry. We debit unearned revenue and credit rent revenue of $600. And this is calculated as 1,800 multiplied by 1 divided by 3 because we have earned 1 month rent. Now let's look at accrued expense. Accrued expense is also called expense payable. It indicates that the expense already incurred in the period but not yet paid. So we have a present obligation to pay it. So accrued expense is a form of liability. Examples include wages owed to employees at balance day, interest owed to the bank at balance day, utilities expense owed to providers at balance day, and any tax owed to the tax office at balance day. If we do not adjust for accrued expenses, we will have understated both our expense and liability. So we need to recognize accrued expense. Let's look at a few examples. First, firm pays wages of 10K every Friday. Month end is Wednesday. Let's assume that the previous payday is 26th of May. So debit wages expense, credit cash at bank $10,000. Note that this is not an adjusting entry, it is only a normal entry. Then on 31st May, let's assume that 31st May is the balance day. We will perform the adjusting entry. So we debit wage expense and credit wages payable of $6,000, which is 10K multiplied by 3 divided by 5, because we are only owing 3 days of wages. So we need to apportion that. Another example, we consume 8,000 kilowatt hour of electricity at 10 cents per kilowatt hour, and we also owe 10% interest on a $3 million loan. So on 31st May, we debit electricity expense and credit accrued electricity $800, which is 8,000 multiplied by 10 cents. Then we also debit interest expense. We credit interest payable at $25,000. That is calculated as 3 million multiplied by 10% multiplied by 1/12, assuming that we owe for a month interest. Finally, let's have a look at prepaid expenses. Prepaid expenses are expenses that are paid for before they are used. Because you are entitled to use the service or to generate future economic benefits in the future, the prepayment is an asset. Prepayment can be current or non-current depending on how long you have paid for. So examples include subscriptions from the customer's point of view, office supplies such as toner cartridges, prepaid insurance, and prepaid rent. Let's have a look at a few examples. First, on 1st of May, we pay $1,200 for an annual insurance premium. So we debit prepaid insurance to recognize this asset, and we credit cash at bank $1,200. And again, the transaction on 1st of May is not an adjusting entry, it is only a normal entry. Then, at June 30, we perform the adjusting entry, we debit insurance expense, we credit prepaid insurance to show that we have consumed 2 months of insurance for May and June. So $200, and $200 is calculated as 1,200 multiplied with 2 divided by 12. Another example, we purchase office supplies on 1st of June, but at 30th of June, only $300 left. It means that we have used up $700 of office supplies. So on 1st of June, we debit office supplies, credit cash at bank $1,000. So this is not an adjusting entry. And 30th of June, we do the adjusting entry. So we recognize, we debit office supplies expense, and we credit office supplies $700 to reflect the consumption for the month. Alright, student tasks. Please prepare the following adjusting entries. Assuming that you have attempted this question, let's check the answer. First, because sales revenue for the year included 360k of customer deposits for products and services that have not yet been shipped and supplied to them, we need to reduce sales revenue by a debit entry of 360k, and we recognize a liability by credit unearned revenue 360k. Next, at year end, 2 days' wages are owing, so we debit wages expense, credit wages payable or accrued wages, and it is calculated as 800k weekly wages multiplied by 2 divided by 5, so 320k. Third, the company is owed interest on investment by the bank for 280k at 30th June. So we debit interest receivable, credit interest revenue 280k. We have earned the interest, but we have not received the interest from the bank for our investment. Next, we prepaid for 12 months insurance and we have consumed 3 months of insurance up to balance day. So we debit insurance expense, credit prepaid insurance 120k. This is calculated as 480k multiplied with 3 over 12. Let's have a look at the fifth item. The rent received in advance account had an opening balance of 720k. At the year end, the correct balance is 240k. What does this mean? It means 480k of rent has actually been earned. So we reduce the liability with a debit entry. We debit rent received in advance, or unearned rent revenue if you like, and we credit rent revenue 480k. Next, a total of $40,000 was debited to the office supplies asset account during the year. At year end, $7,000 of the supplies remains. It means that we have consumed 33k of office supplies. So we debit office supplies expense, credit office supplies at 33k. Finally, the company took out a $4 million loan on 1st January 2016 at 8%. Interest is paid annual in arrears. So half-year interest is actually owed. So we debit interest expense, credit interest payable 160k. It is calculated as 4 million multiplied with 8% and then multiplied by 6 over 12. In the next 2 slides, we will briefly look at allowance for doubtful debts and depreciation. They will be covered in greater details in later weeks. We will also recognize bad and doubtful debts at balance day if we apply the allowance method. Bad and doubtful debts reveal what percentage of accounts receivables are considered doubtful or not being able to be collected by the management because customers may default their payment. Note that the customers have not defaulted. It is just an estimate that how much receivables may not be collected. We will use an account which is called allowance for doubtful debt account. This is a contra asset account or a negative asset account. So it has a normal credit balance. To increase it, we credit. To decrease it, we debit. When we create allowance, we will debit bad and doubtful debt expense and we credit allowance for doubtful debt. On balance sheet, we will deduct allowance for doubtful debt from gross accounts receivable to obtain net accounts receivable. By doing so, we report accounts receivable and net realizable value. We will cover allowance for doubtful debt in greater details in topic 6. Next, let's have a look at depreciation. Depreciation is to allocate the cost of tangible asset over their useful life. Because we consume tangible assets over time to generate revenues, we should also recognize the corresponding expenses. We can only use tangible asset for a limited period of time to generate revenue, and they are subject to wear and tear. So we should do the internal adjustment to recognize depreciation. Most tangible assets are subject to depreciation except land. We do not depreciate land. We will use two accounts. First, depreciation expense. Depreciation expense is an expense account, so we record depreciation expense in profit and loss statement. It is to show only this period's depreciation expense. A cumulative depreciation account, on the other hand, will be reported in the balance sheet. It reflects how much depreciation has been recorded so far. So the figure is cumulative for accumulated depreciation. This is a contra or negative asset account. So accumulated depreciation has a normal credit balance to increase it with credit. For example, a plant has 5 years useful life. If we assume straight line depreciation, meaning we will recognize the same amount, the equal amount of depreciation every year, we will debit depreciation expense, credit accumulated depreciation $20,000, which is 100K divided by 5. 3 years later, the book value or carrying amount of the asset will be 40K, which is the original cost 100K minus accumulated depreciation of 60K at year 3. The 60K is calculated as 20K multiplied by 3 because each year 20K, so 3 years 60K. We will discuss depreciation more in week 9. Alright, let's now look at closing entries. We are now in step 6 of the accounting cycle. Note that we only do closing entries on reporting date or on balance date. We only need to perform closing entries for revenue and expense accounts because income and expense accounts are temporary accounts. So why do we make closing entries? We have different accounting periods. In each period, we need to determine the financial performance. We want to see what is the profitability. We won't be able to tell the net profit for a period if income and expense accounts are cumulative. Because of this reason, we must reset the balance of income and the balance of expense to 0 at the beginning of the next period. When we do the closing entries, we will create a temporary account which is called profit and loss summary to determine the net profit or loss. And what is the process? First of all, we will debit all the revenue accounts and credit P&L summary. We then credit all expense accounts and debit P&L summary. In P&L summary, we can tell whether we have a net profit or net loss. We then close P&L summary to retain profits account. For other temporary accounts like dividends or drawings, we will close to retain profits. We do not close asset, liability, and equity accounts because they are permanent accounts. However, we will calculate the closing balance for asset, liability, and equity accounts so that they can be carried forward to the next period. This is the example for closing entries using the ledger accounts T accounts format. So sales revenue and interest revenue are income. They have credit balance. To close them, we debit. Okay, so to close them, we debit and we transfer the figures to the credit side of P&L summary. On the other hand, wages, cost of goods sold, and advertising expenses are expense accounts. They have a debit balance. To close them, we credit. And we will transfer the figures to the debit side of P&L summary account. Next, in P&L summary, we can determine the net profit or net loss. The credit figures, which are based on income, are much greater than the debit figures, which are based on expense. Therefore, we have a net profit of 84k in this case. We would then close this net profit 84k with a debit entry in P&L summary account, and we transfer it to the credit side of retained profits account. Now let's look at reversing entries. You made reversing entries on the first day of the new reporting period. Say you do it on 1st of July or 1st of January. We do not do reversing entries at reporting date or balance date. Okay, so that's the difference. When you talk about adjusting entries and closing entries, we do adjusting entries and closing entries at balance date, at reporting date. But we only do reversing entries at the start of the new period. The main purpose of reversing entries is to reverse certain internal adjustments made in the previous period to simplify accounting records for the next period. And it is to avoid double counting of expense and income accrued in the new period. However, not all adjustments can be reversed. The following adjusting entries are reversed, which include accrued revenue, accrued expense, unearned revenue that is initially recorded in a revenue account, and prepaid expenses that are initially recorded in an expense account. The following adjusting entries cannot, however, be reversed. So we cannot reverse unearned revenue that is initially recorded as a liability. We cannot reverse prepaid expense that is initially recorded as an asset. And we do not reverse depreciation, bad debts, and other allowances. Note that reversing entries are not compulsory. They are totally optional. Let's have a look at an example. In this example, weekly wages are $1,400 for 7 days. Sorry, $14,000 for 7 days. So 1 day is $2,000. It is paid every Monday for the previous week's work. 30th of June in this case is on Tuesday. So 2 days of wages are owed, which amounts to $4,000, because $2,000 times 2 equals to $4,000. So the accrued wages is $4,000 in this case. On 30th of June, you will recognize the adjusting entry, so debit wages expense, credit wages payable, $4,000. Then, on 1st of July, at the start of the new period, you can choose to reverse it if you want, because we are allowed to reverse accrued expense. If we want to reverse it, we will debit wages payable, $4,000, and we credit wages expense, $4,000. Then, on 6th of July, when we pay the wages, we will debit wages expense, $14,000, and we credit cash at bank, $14,000 for the previous week's 7 days salaries. Alright, student task. Based on this unadjusted trial balance and the following information, please complete a few requirements here. So let's assume that you have attempted this question. We will first perform the adjusting entries. First, we owe receptionists $1,000 in unpaid wages. So we debit wages expense, credit wages payable, $1,000. Second, depreciation charge on motor vehicle is $500 and depreciation charge on office equipment is $750. So we debit depreciation expense for motor vehicle, credit accumulated depreciation for motor vehicle, $500. We will also debit depreciation expense for office equipment and credit accumulated depreciation for office equipment $750. Third, when we count the office supplies at balance day, $350 left. So to recognize the consumption, we would debit office supplies expense and we credit office supplies of $850. That is the difference between $1,002 and $350. Next, unpaid electricity expense was estimated at $200. So we debit electricity expense, credit accrued electricity $200. Moving on. 3-month insurance premium prepaid on 1st of June was initially recorded as an asset. Here, we need to adjust to reflect 1 month consumption. So we debit insurance expense, credit prepaid insurance $1,000, which is $3,000 divided by 3. Because the insurance premium is for 3 months, and we have only used up for 1 month. Finally, the bank loan was obtained on 1st of June, and we haven't paid any interest. We need to recognize 1 month interest expense. So debit interest expense, credit interest payable $300. And how do we calculate this? Loan amount $60,000 times 6% divided by 12, just for 1 month interest. The second part requires us to do the posting. For this exercise, we only need to do posting for wages expense and office supplies. So have a look at wages expense account. Initially, when we paid for wages, we debit wages expense, credit cash at bank. From unadjusted trial balance, we find that we have paid for $20,000 of wages expense so far. So at the debit side, we insert $20,000 and we use cash at bank for cross-referencing. And recall that previously when we did the adjusting entry, we further recognized $1,000 of accrued wages, the amount that we owe to the receptionist. So we insert $1,000 at the debit side of wage expense account and we use wages payable for cross-referencing because we credit wages payable. Then have a look at office supplies account. Initially, when we paid for office supplies, we debit office supplies, credit cash at bank. From unadjusted trial balance, we find that we have paid for $1,200 for this period. So at the debit side, we insert $1,200, but we use cash at bank for cross-referencing. And when we did the adjusting entry, we have recognized $850 of consumption. So we put $850 at the credit side of office supplies account. So office supplies is an asset account, so we put at the credit side to reduce the asset. But we note office supplies expense for cross-referencing because that is the account that we debit. Okay, so we debit office supplies expense, we credit office supplies. Alright, after you have done the previous parts, let's now prepare an adjusted trial balance to see whether your total debit figure equals to your total credit figure. So our bank will have a debit balance of $224,400, accounts receivable debit balance $16.5K, office supplies in this case is $350 because 1,200 minus 850. Prepaid insurance, we have a debit balance of 2,000 because 3,000 minus 1,000. Office equipment, 12K debit. Accumulated depreciation for office equipment is $750. We need to credit this. Motor vehicle 16.6K debit. And we have accumulated depreciation for motor vehicle credit 500. Accounts payable 4.4 credit. Wages payable 1K credit. Accrued electricity credit 200. Interest payable credit 300. We have bank loan 6% interest per annum. So the principal amount for the bank loan is credit 60K. Capital 120K credit. And we have drawings. Drawings is a distribution of equity. And we know that equity has a normal credit balance. Distribution of equity will reduce equity. So it is a contra equity account. Therefore, we put $3,600 of drawings at the debit side because it is a contra equity account. Okay, so drawings debit 3.6. Service fee revenue credit 122.8K. Rent expense 9K debit. Advertising 900 debit. Wages 21K debit, which is equal to 20K plus 1K. Office supplies expense debit 850. Electricity expense debit 200. Insurance expense debit 1000. Depreciation for motor vehicle debit 500. Depreciation for office equipment debit 750. Interest expense debit 300. So your total debit must equal to your total credit, which is 309,950 in this case. Moving on, we are required to perform closing entries. On June 30, we would debit service revenue, service fee revenue, and credit P&L summary 122.8K. We then credit all sorts of expense accounts, including rent expense 9K, advertising expense 900, wages expense 21K, office supplies expense 850, depreciation for motor vehicle and office equipment 500 and 750 respectively, electricity expense 200, insurance expense 1K, interest expense 300, and we debit P&L summary with the total of 34.5K. Now in this case, do we have net income or do we have net profit or net loss? Because our revenue 122.8K is greater than the total expense of 34.5K, so we have a net profit in this case. So the difference actually indicates a net profit. And how much is a net profit? 88.3K. So moving on, we will close P&L summary with a debit entry and transfer the net profit to the credit side of retained profit 88.3K. Because we also have a drawings account, it needs to be close to the retained profit. So we debit retained profits, credit drawings. Remember, drawings is a contra equity account because drawings has a normal balance at the debit side. To close drawings, we credit drawings and we transfer the amount to retained profits. So that will reduce retained profits by $3,600. Okay, let's do the posting to P&L summary ledger account. At the credit side, on 30th June, we have 122.8K and we state service revenue for cross-referencing. And we debit on 30th June for 34.5K and we state various expenses for cross-referencing. We must close the net profit of 88.3K to retain profit. So on June 30th, at the debit side, we put 88.3K and we state retained profits for cross-referencing. So P&L summary does not have any closing balance or opening balance in this case because it is only a temporary account. We then post this to the credit side of retained profit. So at the credit side of retained profit, 88.3K, which indicates the net profit for this period. Because we know that retained profit has a normal credit balance and net profit will increase retained profit, therefore we credit it. But we put P&L summary for cross-referencing. Then, at the debit side, we put 3.6K and state drawing for cross-referencing. Retained profits are an equity account. It is a permanent account. We do not need to close it, but we need to calculate the closing and opening balance. Closing balance is stated at the debit side on 30th June for 84.7K, and immediately the next day, 1st of July, we post it to the credit side 84.7k as opening balance. Then we can prepare the income statement. So we start with service fee revenue 122.8 minus all sorts of operating expenses. That includes rent expense 9k, advertising 900, wages 21k, office supplies expense 850, depreciation for motor vehicle and office equipment, which are 500 and 750 respectively, electricity expense 200, insurance expense 1000, interest expense $300. So the total operating expenses are 34.5. So 122.8 minus 34.5, we get our net profit 88.3k. Next, we can rely on those previous information to prepare a balance sheet. So we start with current assets. Bank 224.4. Accounts receivable 16.5, office supplies 350, prepaid insurance 2000. Our total current asset is 243,250. Then we prepare for the non-current assets. Office equipment 12k minus accumulated depreciation 750. We get 11250. Motor vehicle 16.6 minus accumulated depreciation 500. We get 16.1. So our total non-current asset is 27,350. And our total assets is 270,600 in this case. Current liabilities. We start with accounts payable 4.4, wages payable 1k, accrued electricity 200, interest payable 300. So the total current liabilities is 5.9k. And we have bank loan as non-current liabilities 60k. So the total liabilities is 65.9k. Equity, we have capital 120k. Retained profits is 84.7k. So please refer to slide 37 to see how this closing balance is derived. So our total equity is 204,700. And our total liabilities and equity is 270,600, which is equal to total asset. So our accounting equation is balance. Okay. Finally, reversing entries. Recall that reversing entries are not compulsory, and we only do reversing entries for certain types of adjusting entries. Here we can reverse accrued wages. So debit wages payable, credit wages expense 1k. Okay, and please use the correct date. We only do the reversing entries at the start of the new period. So that's 1st July in this case. And we can also reverse accrued electricity expense. So we debit accrued electricity, credit electricity expense $200, and interest payable as well. So we debit interest payable, credit interest expense $300. Note that we do not reverse depreciation, office supplies, and insurance, balance day adjustments, because we do not reverse things that are already consumed. Okay, please prepare revision question 3, and we will discuss it at the start of the next topic. Thank you.